Welcome back to the Real Estate Standard Podcast. This is episode 26, where commercial real estate and Bitcoin collide. I'm your host, Tim Kotzman. Today is June 30th, 2026. Each episode, we break down how serious operators, investors, and developers stay competitive and profitable in the 21st century by examining commercial real estate through the lens of Bitcoin. On today's episode, we'll be discussing the topic of balance sheet management. And now, I'll hand it over to Kenny for an update on Westmain Storage stacking.
Hey, Tim. Thanks for that. As of today, June 30th, we hold 15.4 Bitcoin. That's 1.5 billion Satoshis. So far in 2026, we've stacked a little over 13 Bitcoin, 1.3 billion sats. And our Bitcoin yield to date is over 600%, 604%. So what does that mean? We've 6 times our Bitcoin since January. Bitcoin per square foot is over 22,000 at 22,191 sats per square foot. We have officially achieved Bitcoin square foot parity. What is that? There's approximately 97 billion square feet of commercial real estate in the United States. If you divide it by all the Bitcoin that there will ever be, 21 million, you get 21,649 Satoshis per square foot. And we're over that by about 420 sats. I'm going to go through the dashboard a little bit today. Let me know if you can see it, guys. We're going to go over to the real estate tab here and check out our Bitcoin mortgage coverage ratio. We've had a pretty significant drawdown in Bitcoin from the highs, and we're still able to cover 3 years, 3 months of mortgage coverage with our Bitcoin holdings. And with our digital credit coverage, we're at 3 years, 1 month. And together that's 6 years, 4 months. And then lastly, I just wanted to go over on the digital credit page here, we got an announcement earlier this week that Strategy is going to increase the dividend payment for Stretch, the digital credit instrument that we've purchased around $1 million of, to 12%. So that's going to actually boost our annual dividend income from 115,000 to 120,000, and it actually we were operating at a slight loss there with the money that we borrowed with an announcement we did in May, the half Stretch, half Bitcoin acquisition, where we did a self-carrying loan. It was slightly under. It was costing us about 3,000 a year. Now we're slightly over. We're going to be actually in the green slightly at $1,764, and that allowed us to capture over 9 Bitcoin. So what do you think so far, Chris?
It's it was kind of funny hearing you say the Bitcoin return is 600%, right? I mean, last time I checked, Bitcoin was dead again, and we're in the depths of a bear market. So to hear you say we're up 600% on the Bitcoin position is music to my ears, to say the least. But achieving Sats parity is also exciting. I think the last time we had mentioned this, we were on track to achieve that in, I think, the end of August, early September, if my memory serves me correctly. And now with this recent Bitcoin sale that we're going to talk about here today, we were able to capture that a little bit quicker than what we were modeling out. So that's another huge milestone as far as I'm concerned.
Yeah, let's jump right into that, because we did something pretty controversial. We sold our Bitcoin, but only for a little bit. We bought it back, and we thought about this. We've been teasing about it for the past month, and
You inoculated the market, Kenny.
Well, we followed in Strategy's footsteps. I mean, we sold about a third of what they sold, so we're kind of, when you compare those numbers, we're in the same ballpark. They sold 32, we sold 11. Except for that was 70% of our stack, about 72% of our stack compared to it was like, a millionth of a percent for them. But the more we thought about it, and we had offline discussions, and the more I thought about it and realized that actually to a real estate operating company, those tax laws are more valuable to us than it would be to a pure Bitcoin company. So
Kenny, why don't you just give the listeners just a quick overview of what this is, why you're able to do it? Because I think a lot of the real estate folks may overlook the fact of that Bitcoin's classified as property.
yeah, so the IRS has classified Bitcoin as property for at least 5 years now. I think it might be a little bit longer. And what that means is there's no wash sale rules when it comes to trading. A lot of people think of Bitcoin as a stock and number go up kind of thing. And it's very different from a stock for many different reasons. And one of them is the classification. It's not a security. It's not subject to the SEC rules where like securities like Strategy, their preferred stocks, they have very specific rules on whether you can, but like the frequency and the time in between of buying and selling, and whether that's considered a loss that you can write off on your taxes or not. So with securities, you have to wait 30 days. With Bitcoin, you don't have to wait any time at all. So you can recognize a loss if you're in a situation where you bought high and you're seeing a considerable loss, you can capture that loss. Now you have to have a gain somewhere else to offset it. And that's why I said um, it's more valuable to a real estate operating company than it is to a pure Bitcoin company, because we have real estate operations where we may sell a property. We may buy a property, sell a property. Um, Maybe we do something that creates a taxable event where, like, I can think of one property where we have a cell tower and we have a ground lease with Crown Castle. And we always think, well, maybe we should sell the ground lease. But then we're like, hey, we'll have a big tax hit if we sell that ground lease, right? And if you have these tax losses that carry forward indefinitely, they don't expire. It makes the optionality that you have as an operator increases. You have more options. Maybe you can sell that cell tower and realize the gain and offset the gain with the tax losses, and then you can convert that into Bitcoin or digital credit. So I'll just pause there because I wanted to just get your feedback, Chris, on this, and make sure you're chiming in here. And then I wanted to show the breakdown of how we did it.
Yeah, no, awesome. I really like it for a number of reasons. I mean, I think the bigger point, which you kind of alluded to, is the optionality that it gives. The other, I think, the really important thing here, which is ultimately a broader theme, is that this is active balance sheet management in commercial real estate, which is not the norm with or for the traditional players. So we're introducing a new strategy here, a new mechanism to create that optionality, to become more efficient from a tax perspective, and ultimately increase profitability over the portfolio. So and we're going to hit on this active balance sheet management a little bit here today, but I think that's the bigger kind of piece to all of this is there's some unique characteristics to Bitcoin. We are taking advantage of those. essentially taking advantage of the volatility in addition to the existing rule set. And the marketplace is volatile, and we're taking advantage of that to our advantage.
Yeah, I think like as an individual, I, have just held Bitcoin and haven't tried to like do any of this tax loss harvesting, but from a business perspective, you have to think it in different terms because now you have to do what's best for your shareholders. And if you're trading at a loss and you're planning on holding it long term, you can realize this tax loss, which for us, we realized $261,000 loss. And in dollar terms, at a 37% tax rate, that's a little under $100,000 in dollar for dollar tax credit, so $96,000, which you can allocate a very small amount, like 3,000 towards ordinary rental income, but really you're banking it and trying to build up enough so that you could potentially sell one of your properties in the future and minimize the tax obligations. Or another use case, Chris, that we've talked about is you could potentially sell your digital credit in the future, and there could be a capital gain there. And as you reduce your return of capital, as you reduce your cost basis, eventually you'll have a taxable event. So 10 years down the line, even if you don't sell any digital credit and you're holding it for 10 years, after you fully recoup your full investment there, those dividend payments will become taxable at some point. And when you sell the underlying asset, when you sell Stretch, and you recognize a gain, you will have a taxable event, and you can use it when you sell that those assets. And so in times like, another kind of can of worms that I started looking at, and I'll update the screen here. Let's go over to the digital credit section over here for a second. Started looking at doing the same thing for the Stretch, because Stretch has gone down 16%. It's being, under fire here as of the last few weeks, and we have an unrealized loss of 111,000 with the digital credit. Now, we're not necessarily concerned about that because we have a long-term horizon. We're going to hold it until we get our full return over 8 years. We'll have our full return of capital, even less now, I think slightly under 8 years now that it's at a 12% dividend. And we're just looking at it like, hey, well, if you can realize another loss, and right now it would equate to a $41,000 tax savings, dollar for dollar, at a 37% tax rate. Is it worth it? Now, there's different considerations that we were just talking about where you wouldn't be able to buy back the Stretch right away because that would trigger the wash sale rules. But what you could do is you could reallocate it to a different digital credit instrument. Now, there's different risks there. These instruments might not recover as quickly as Stretch. There's not as much liquidity, but it's still something that you have to look at. And there's a scenario where you could break it up into, to a few different instruments. You could put 25% in SATA, Strive's digital credit instrument. You could put 25% in Strategies STRD, which is more of like a riskier down, it's like the equivalent of their junk bond on their yield curve, where it sits below STRF, STRC, and then STRK. It's the lowest ranking preferred instrument. And there's different things like that one isn't cumulative if they skip a dividend, or they could skip a dividend on that one, and it, you wouldn't necessarily be entitled to that skip payment. So there's different considerations with each of these instruments, but we're just looking at, what options do we have? I think at this point, it's like not necessarily worth it, for us to take that extra risk because of the wash sale rule, but it's something we're paying attention to, and you know, it could increase our digital yield. We could also, like in this scenario, we can increase it by 5,000, an extra 5,000, even after strategy has just raised to 12%. You could allocate it in a different way, and if you put it all towards STRD right now, it's 17.8% effective yield. And so we put together an effective yield tracker just to have a quick snapshot of where we're at. As you can see, last week we spiked. I think STRD hit 20%. You can see over here STRD, the red line, hit 20%, and we saw strategy. The management team has put together some new guidance and some new mandates on what they'll do, and one of those things is they've set aside, I think it's like 1.2 billion to buy back press and to buy back some of these trading at a discount. So they could certainly come if they're issuing it at par, which is $100 for each of these, and the market for whatever reason isn't understanding it, they can buy it back for pennies on the dollar. And until the market understands this, they can sell high, buy low.
Yeah, I mean, I think the exercise is definitely worth the time, and it's just part of doing your diligence and making sure you're really looking at all the options available. But going back to the conversation we've had, the last couple of months, as far as letting these not just the products but the strategy that we're talking about here and implementing season, just that on its own, I think is more important than a tax loss situation using the digital credit products, right? Because I think if we're trying to demonstrate to not just the market, but for example, a lender, right, that is adverse to including the digital credit income into the underwriting, that conversation, that argument becomes a lot more difficult to have, and it becomes a weaker argument when they see you trading in and out of these different preferreds, right? Like, so, and maybe if there was a really compelling situation where you almost too good to pass up, you go into a SATA out of all of those different options, because it is a similar instrument as is STRC, right? It's designed to be stable between 99 and 101. It's paying a monthly dividend, so maybe there's a case to be made there. But I think looking at going into any of the others this early on in the game is probably a mistake, just from again the seasonality standpoint, and demonstrating that this is the strategy. Here's why it has value and needs to be included in the underwriting. Just like the issues you had back in the day with solar, Kenny, right? Like getting them to include the solar income. We are really blazing a new trail here in the industry, and we're not just doing one thing, right? Like we're we pulled the rug out from under the traditional real estate folks, and they're having a hard time just getting on board with Bitcoin itself. And now we're throwing in digital credit and all the other exotic approaches as well.
Yeah, maybe it's like a good time to kind of talk about, like, I know that my opinion on digital credit has been evolving. So I like I think I look at them as building materials. Like I look at it like steel, I look at it like glass, I look at it like cement, right? When you're building a commercial building, you take these raw materials. Where did they come from? Well, they're they're extracted from the earth, a lot of them, right? And so you have to have land, raw land, and that's Bitcoin. Bitcoin's the raw land, and you're able to create from the land, you're able to extract from the land these building materials. And that's what Strategy and Strive have done. They've created these building blocks in which I think we're able to assemble, because we started off with Bitcoin. We started building a foundation in Bitcoin, and we're building our own self-storage facility in cyberspace, essentially. And we're trying to mimic the yields of a self-storage facility. We know the profit margins. We know how much cash flow can come out of a certain facility size, and what the drag is. And we're trying to reproduce that with Bitcoin, and essentially grow our footprint without actually physically expanding. And I think that's the reason we came up with the Bitcoin per square foot metric that we've been getting a little traction with, the sats per square foot. It really makes a lot of sense to have, like, when you have a dual collateral, when you have like this extra backing of an asset that is complementary. I think it allows you to like offer your shareholders tax efficient dividend payments. You can offer them return of capital disbursements, right? And you're really transforming ordinary rental income into a more tax efficient income stream by blending these these instruments that are powered and backed by Bitcoin, right? Like, the reason they can offer these products is because they're like real estate, right? They're leveraging the real estate. How do, like, most people in real estate make money in the commercial side? Through a refinance, right? They do a value add, they do sweat equity, they improve the property. So what has Strategy done? They have like hoarded all this Bitcoin, and they're trying to build on top of it, and they're saying, hey, we want to acquire more of this raw land, and we're willing to pay you a high dividend rate. And they can do that in a tax deferred manner because they're not selling their Bitcoin. Now there's opportunities for them to sell high basis Bitcoin at a loss. But the main thing is that they're not showing a profit, right? And
Well, and I
when
think
you're able,
that's, sorry to interrupt you. Go ahead.
yeah, I was just gonna say, like, when you're able to have unrealized gains, and that's something Bitcoin and real estate really both have, is like when your property value is going up, you don't sell it to recognize the gain. You go and refinance the property, and you get the money tax free. Now with Bitcoin, you can't necessarily refinance your Bitcoin just yet. Like, the products don't exist yet. So this is a way to kind of mimic that idea of refinancing your property. Again, we talked about at the beginning of this episode, Bitcoin is property. It's just that we don't have the same lending businesses in the space yet that are like they're being built right now as we speak, but we don't have the same tools that the real estate world has after hundreds of years of dealing with real estate.
Yeah, and I think that's where the bulk of the conversation should be focused on is the tax component of this transaction, why we did it, right? I always joke and say that real estate investors are experts at not paying tax, right? I mean, that's there's some truth in that. But beside Bitcoin and digital credit aside, I mean, real estate investors are always looking at different ways to become more tax efficient, right? Whether it's through depreciation and cost segregation studies. You can do 1031 exchanges. The example you used, Kenny, with refinancing versus selling. These are all traditional real estate mechanisms to increase the tax efficiency or to save on taxes at the end of the day. And now when you're using Bitcoin as this new tool in the real estate portfolio, you now have a new lever to pull from the tax efficiency standpoint. And that's what, Westmain has done here with this tax loss harvesting transaction. And I think, Kenny, there's a handful on the press release you guys put out here. There's some really interesting data points that I think we should run through just to not only illuminate the details, but kind of hammer some of these points home. Do you want to run through those? Or you want me to?
I'm happy to go through them with you. I'll pull up our PR here with our. We were initiated into the 58K gang. We can make a quick joke about that, because this has been the lowest Bitcoin has been since we started stacking. So we were able to accumulate 17 million Satoshis today at 58,000 per Bitcoin. And there's a long-standing meme within the community that, 58K, it used to be the top and now it's the bottom, and it's just a special number in the Bitcoin community. But yeah, so this, once again, we were able to average down with our weekly purchase. This is 49 weekly DCA purchases at the same price every week, or the same amount every week, $10,000. Yeah. Was there something you wanted to point out? I think you're on mute, Chris.
Sorry, thank you. Yeah, I just wanted to walk through the details here because you alluded to some of it at the beginning here, but I think there's a lot more to kind of dive into. So Westmain sold 11 Bitcoin from the treasury, right? And then using
Oh, you know what? Let me pull it. I pulled up the wrong article here. I thought you meant today's article, but you're talking about the tax loss harvest article, yeah?
correct, yeah.
So we've been doing press releases now for, I think, almost 20 weeks. So let's see here. I think it was this one. Yep.
Yes, there you go. So sold 11 Bitcoin, and then using the existing rules, you were able to buy those back out, or buy back the essentially the same 11 Bitcoin plus a few extra Satoshis. So explain to the audience here the accounting method that was used. We already covered the loss, but the accounting method, and then how you were able to acquire some additional Satoshis in the transaction, which ultimately made it a net accretive transaction, and some of the return metrics here. I think there's a lot to dig into on this.
All right. Yeah. Let's unpack it. First off, you have to identify your highest and first, like, you want to make sure that you're selling your high cost basis Bitcoin. And how you do that is you're using a rule called the highest and first out, HIFO. And so you want to have all your Bitcoin lots and know, like, where they are. We have on our website, I'll flip back and forth here. Let's, because we have another chart that really helps with this, and you can see where our lots of Bitcoin are. See, we had this like visualization here, and it helped us kind of say, like, let's sell all the lots between, like, above 90,000. Let's make sure we sell all the Bitcoin that we bought above 90,000. That's going to be the largest gain that or loss that we can capture, rather. And so that was like step number one. Step number one is identify the Bitcoin that you're going to sell. The reason why we did 11 and it was roughly 70% was because there wasn't enough meat on the bone, essentially, for some of the more recent purchases that were within, just 10% of the price. So you don't want to incur fees on selling it. Just, that was the other thing, was we watched for like a month, we were paying. I don't normally pay that close attention to the Bitcoin price, but when you're going to execute something like this, you informed me that there's some businesses that do assist with that. I wasn't aware of it, so for me, what I did was I just had a heightened sense towards like the price. Like I was paying attention to the price for weeks leading up to it. Noticed that we, were started to slip downward. And so that's when I decided to do that, because you don't necessarily want to sell it at the lowest price because you have to buy it back. That's an
Yeah,
important
exactly.
that's like an important it kind of messes with your mind because you're like, well, I want to sell it at the lowest price to get the highest tax loss harvest, but then you don't want to like have it run away from you and go in the opposite direction and you can't buy the same amount of Bitcoin back. So
And then you also have to account for the transaction fees on the sale and then on the subsequent buy, right? So
exactly.
you got to bake those into the cake, so to speak.
So once I saw price kind of like there was some bad news, whatever it was, there was some like, announcements about the Iran war. And so I figured, hey, this is an opportunity. The price is probably going to bleed down for a little bit here. And we were willing to pay like that. I think that's another thing that you have to be willing to do. We were willing to to lose like a small amount of Bitcoin, right? We were willing to say pay 10 million sats to do this because we're going to actually get like $100,000 coupon to the IRS, so to speak, right? Like we're going to
Mm.
have this gift card to the IRS. It's $100,000. How much are you willing to pay for that? It's got to be worth at least a couple percentage points of the face value, right? And so I think we were willing to like do this at like a small net loss of our Bitcoin holdings. Like we were willing to pay sats out, pay Bitcoin to be able to get this tax loss harvest. Um, but because we were in tune with the market, we were paying attention, and like didn't just kind of panic FOMO into it. We were able to kind of zero out and zero out those expenses. So we actually sold it for $1,000 or so higher. We can see right here the average cost basis. Let me see. Go back to this tab. We can actually see the actual transactions here. So when we sold it, it was at 64,195. And when we bought it back, it was at 63,441. So not quite $1,000 move, but that happened relatively quick. Bitcoin, and can move like extremely quick. It can, we've seen 10% days. So this is not crazy, but it's still kind of noticeable. But back to the process here. Um, yeah, you just had to be very aware of the situation. You had to know like what kind of fees you're looking at spent, like, like you have to think in Bitcoin terms too, because we sold 11 Bitcoin. So we know that we want to try to buy back 11 Bitcoin. And that can just really mess with you, because if you're like trying to get the full 11 Bitcoin back and the price goes up, like are you gonna risk it, kind of thing. So it you know you got to really think it through. And I think
There's a
real
lot of
estate.
mental gymnastics that go into it, is what I'm hearing.
Yeah, and like I think real estate guys and operators understand, like you got to think things through when you do these types of real estate deals too. So it's
Yeah.
just kind of having all the cards faced up on the table. Like you want to know what's the worst case scenario. The worst case scenario, it's going to cost you a couple $1,000, right?
Exactly, and I think that's an important point to hit on too. Is, I mean, the way you engineered this was perfect, right? It was a home run in every way, shape, or form. But if you were in a scenario where maybe you weren't able to have a a net accretive accumulation, right? 5,248 sats additional. That's not the end of the day, right? If you broke even on it, maybe even gave back a few sats, that is not the end of the day, especially when you're looking at a $200,000 loss, plus $200,000 plus loss that you have now that you can carry forward indefinitely. That is meaningful, and that again it provides optionality into the future, right? For what if you're offsetting like future Bitcoin gains, you're offsetting gains from other real estate transactions, you're offsetting gains from securities, right? I mean, there's a handful of different ways that this loss can be applied, and you don't necessarily need to live and die by every single Satoshi, right? I think that's the bigger point here, because you and I are living and breathing this and loving just every moment of it, but you got to put yourself in the shoes of a CFO of a large real estate firm or family office, right? They don't have the time to sit there and just be autistic on the price movements for 2, 3, 4 weeks leading up to it, right? So it's just being able to zoom out and just look at the bigger picture. How does is the strategy or is this maneuver applicable to the situation? If it is, what are the dollars, what are the numbers behind it, and does it make sense from there? Again, I think you hit it out of the park in every one of the categories in this particular scenario. But to your point, Bitcoin can move so quickly in such a short period of time. That's not always going to be the case, right? I mean, we could fast forward, however, whenever it ends up being, maybe Bitcoin's at 500 grand. And the market presents another opportunity to do another one of these transactions, and it falls to 300 grand. Right. I mean, in that scenario, you have to do the numbers, calculate it out and be very intentional about how you approach it. And if it doesn't then end up being a net accretive Satoshi maneuver, that's not always going to be the nail in the coffin, so to speak.
Yeah, that's what it's all about, is the optionality. But I think, real estate guys can relate because, I kind of keep a heartbeat on the market as far as, my neighborhood, where I live, where my house is, and just where I do business with commercial real estate, right? Like, you just want to know what's in your market with transactions, what's selling, what's sitting on the market. And that's you don't have to be staring at the screen 24/7 with Bitcoin, but like, you want to, when you're going to perform something like this, you want to like just maybe check in and have some notifications set up, so when there's a 1% move or whatever that number is, that it can. And people do that with like Zillow or Redfin or Crexi or LoopNet or whatever you're using to keep a heartbeat on your neighborhood or your area. I think that's just something like second nature to real estate guys, and like you said, it's property. So we're just keeping a heartbeat on the properties.
Exactly. And, I think we mentioned it either last week or the week before, about the importance of using Bitcoin only providers, right? That there are Bitcoin only providers that will help you navigate this tax loss harvest maneuver. So if you find yourself in this a similar scenario, or you're looking at the market and saying, hey, there is an opportunity for me to take advantage of this, just know that, that's a question you should be asking your contact, wherever you buy and sell your Bitcoin, is whether or not they have that service. Because I know for a fact there are those providers out there that have that. And then the second piece of it is understanding what the fees are, right? All these different exchanges, all these different marketplaces have different fee schedules, right? So depending on your situation and the amount of Bitcoin you're buying and selling, those fees, even though they're just a few basis point spreads between all of them, that can become very, very meaningful, right? So that's when you're thinking through how the heck do you do this for yourself. that is another one of those considerations. I think last week I had mentioned, or I highlighted, how well organized you and Westmain have been, right? Tracking all the lots, understanding what the cost basis is, knowing that, hey, I have X percent in the 90K range, I have Y percent in the 80K range, so on and so forth. So you're starting to see, or we're getting to the point where we are able to demonstrate all the different components of this strategy, right? Not just the, number go up Bitcoin component, but also, kind of the behind the curtain pieces as well, right? The governance, the systems, the protocols, the fees, everything that kind of goes into making these strategies valuable and ultimately accretive to the real estate property. And I think that's incredibly important, and we should very much stress that. I don't want the real estate community to overlook that, right? Because you think about just operating the real estate assets, there's a lot that goes into it that the average person doesn't see, right? I mean, and that varies from self-storage to retail to office, so on and so forth. This is no different. So it's incredibly important to think about the plan, to memorialize it, have some guidelines in it, have some systems and protocols that define the strategy. Who has decision-making authority? What are the critical nodes that need to occur for something to be viable, so on and so forth. There's a lot there.
Yeah, no, I'm excited that we got a chance to kind of do like an analysis on this because there is a lot of moving parts and you just need to like be aware. And I think we're just trying to educate as many people in the space that may want to try to time something like this and what kind of thought and consideration goes into it. um the exchange fee that we paid was 0.59%. So it got me thinking afterwards, like maybe I should be looking at other exchanges. I had been
Yeah.
just using what I had used as an individual, and I'm noticing, hey, wait, maybe there's something better for business. So that's something that we'll be looking at in the future just to compare. Not that we're we don't necessarily need like a free exchange rate here, but if you're like you said, it adds up, right? If you're dealing with $1 million sale, that's 1% is 10 grand, so that's like 5 grand, and you're just a small company trying. That's like half of our weekly DCA, right?
Yeah, and just think of it like this, because if your fees were, what'd you say, 0.5?
0.59, so zero point
So
0.6.
call it point 0.6. There, I know I can rattle off some exchanges, some household names that are 1% or higher, right? So if you now apply that 1% fee schedule onto the Westmain transaction, just from that standpoint, that was not a net accretive um, Bitcoin transaction, right?
Right.
Because that 5,200 additional satoshis, those aren't there.
Yeah, you don't get to buy 11 Bitcoin back. You're buying like 10.9
Yeah.
and change. So, but that's like I said, something like I would even like. I mean, I think that there could be like like this could be like a side business for some of these exchanges, right? Like a something maybe where it's a flat fee. You pay like $500, $1,000, because they can coordinate those transactions within their books. Um, but for like an individual like trying to absorb the fees that they can, because these are transactions that might not occur, right? So in the exchanges point of view, it's like these that they're unlocking more transactions, right? And they're probably going to be higher transactions because these are people that are kind of sitting on the fence, so to speak, whether they're going to capture a tax loss harvest or they're just going to just sit it through. And if there's a way to minimize the risk because they don't want to necessarily lose much Bitcoin, and they can go like they can send it to an exchange, and the exchange is going to handle the fees that are associated with it. Maybe they waive the Bitcoin transaction fees that you paid to move Bitcoin on chain. They have like a lot of kind of leeway in what they can do to offer you the service. And if they're offering you the service, there's a higher likelihood that you're going to maybe buy your Bitcoin there. Maybe you're going to sell your Bitcoin there.
That's exactly right. It's no different from, you need a loan in real estate and you go shop all the different lenders and they say, hey, we'll give you, these deals for your refi. It's going to be great. But the caveat is you got to, bring over $500,000, $1 million in checking funds to
Right.
hang that location. It's no different, right? They're trying to create just as many incentives on the front end to get you in. To hopefully have your business on the back end.
Yeah, it's like a
kind of,
perk. And
yeah, exactly. And I think what you're describing is with some of these exchanges, the private client services. That's what it is. So if you're out there trying to, considering this for your own situation, that's the question you ask your providers. Do you have client private services? And some will say yes, some will say no. Yeah, I think in this episode too, guys, I think we absolutely have to give our disclaimers, right? Like this is not financial advice. Please consult with your CPA, all your trusted advisors before making any particular maneuvers, because there is obviously a jurisdictional component here. Westmain is in Rhode Island, and that market has its own tax laws and rules and everything that we've covered today. So obviously the management at Westmain did their deep dive on that, and they understood what the liability would be, and they elected that they were comfortable with it. So don't sleep on that piece either, right? We've covered a lot here as far as just the transaction itself, but the record keeping and the governance, understanding the jurisdiction that you're operating in. I'd like to think that goes, without being said, but I've learned over the years, not to assume things like that. So add that to your checklist as well, I suppose.
Yep, not financial advice. Tim,
Yes.
do you have a message for us?
A not financial message or a different message?
I was just kidding. I think the community, the greater Bitcoin community, knows Tim from his not financial advice messaging.
This episode may be amazing, but it's not financial advice. This is for informational and educational purposes only. Kenny Alves and Chris Drizga, back to you.
There you
It
go.
reminds me of like the Ready to Rumble, right? Like it's a very you know, good catchphrase in the community.
I want to keep, not today necessarily, but in the future, I want to do an episode on this balance sheet management concept, because I think it's only going to become more and more prevalent and relevant as this continues to evolve. And I think it adds an interesting piece to the real estate guys, right? I was thinking through some of the other like return drivers, if you will, like what drives returns in real estate, right? And you have your typical NOI growth, cap rates, leverage, capital expenditures, capital improvements. Those are the ones, the big categories that have shaped real estate for decades, and ultimately the returns. And now, as you start to think about Bitcoin on the balance sheet in real estate and active balance sheet management at that, you now have, like, you're introducing a fifth return driver to the real estate property, right? And the cool thing about it is that this fifth return driver, this balance sheet appreciation, this balance sheet management, because it's tied to Bitcoin, it's not tied to the real estate, right? It acts as this counterbalance, so to speak, where the ownership value is no longer tied to the building itself or the geography that you're operating in. So I think there's a lot we could probably dive into there as far as this balance sheet strength, this fifth return driver concept.
Yeah, I think I've talked about it a bunch here on this pod, but the solar, the energy cost, eliminating an energy expense. If you're at a 5 cap, that's a 20x. If you're at a 4 cap, that's 25x. You're at a
Yeah.
3 cap, that's 33 times. So like if you some people kind of smirked when I used to try to sell other property owners on solar, right? There was a while where I was offering this as a third party service, and they're like, oh, my common area maintenance, my cam lighting and my cam AC and whatever, it's only 10,000 a year. But if you're at like these cap rates, that's hundreds of thousands of dollars, and you can utilize, like, it's kind of like utilizing underutilized space. Like the roof space is like a unit. You section off, you partition off your building, you segregate it into whatever, it may be 1,800 square foot retail sections, and like ways that we've tried to increase the overall NOI of the property. Like we have properties that have some basement square footage that we were able to lease out, right? So like just trying to find every single square foot that you can lease out. If you can get a cell tower on your roof for your property, that's another great way. They normally don't need much space, but they can be kind of an eyesore in certain places, or they it depends if they're, but I wouldn't, the one I see some people do is like easements. I stay away from easements. I don't want to give anybody access to the property, and kind of have a a negative if you ever were to sell. But like with the cell tower, we had to give an easement to, and so like there's all sorts of ways that you can increase the profitability and the net operation income of the property. Um, Parking. We have a property where we lease out some of the parking spaces. Like we have excess parking, we can lease it to the abutting property, right? There's an abutter, they have a business, they need more parking spaces. We had extra spaces, we can get another extra couple $1,000 a month, and that improves the cap rate, or the valuation based on the cap rate.
Yep.
And I think like once you've exhausted all these like opportunities, whether it's the solar, whether it's parking, whether it's easements, whether it's cell tower, what's next, right? And I think what's next is, well, the tenants of last resort are Bitcoin and digital credit, and they're unlimited in deal flow. You can, like, you can keep expanding and increasing your revenue, and blend it with the physical rent. And I hear some people say, well, isn't that risky? Like, this company strategy, a Bitcoin company, you're trusting that they're going to pay the dividend. And I don't think most people realize how commercial real estate operators work. We see a lot of businesses. We have 60 commercial tenants in our retail shopping centers. We've seen a lot of businesses not make it. When it's time to lease out a space, and we have a very low vacancy. I think we have one vacancy that just came up, and probably lease out right away. But kind of lost my train of thought thinking about that vacancy now.
There are no vacancies when it comes to digital credit.
Yeah, I think that's where I was ultimately going with it. Like what you're doing is you're blending these two incomes, or like in our case, we have three or four or five incomes right now, and you're smooth that out, and a vacancy hit becomes less dramatic. and what you're doing is you're increasing your overall NOI. Whether your lender is going to allow that. I know you mentioned that, for a while our lender wasn't looking at our solar revenue, but this last refi that we just did in the appraisal, they took that into account finally.
Mm-hmm.
And we hadn't refinanced for 7 years or so. So the solar project, the first one, was just under 3 years, or around 3 years old at that point. So it's right around like the point in which it would be considered seasoned, but it didn't make the cutoff, I think, because especially on the East Coast, solar was so new. So it's got this stigma right now, digital credit and Bitcoin, because it is so new, right? Solar panels have existed for over 100 years and just recently became like really mainstream, right? And that's due to the rising energy costs, inflation driven. Um, and so I think it's very similar how digital credit and Bitcoin are going to catch on. That's why I always link it back to the solar analogy, is because with inflation, you're going to see these tools become more and more important. And if your real estate is only appreciating at 5% a year, and historically you were able to suck a lot of equity out of the property because we had 30 years, 3 decades of rates going down. Right now, we're at a weird spot where there's not much room. Like, we can go back to a zero interest rate environment, but there's not much room to fall. We're at like 6%, right? 5, 6%. So that's a lot different when you used to be in double digits in the teens, right? You had a lot of room to fall down. And so you need to pair this asset class, commercial real estate, with something that can have an explosive outer performance. And your real estate is the conservative component that's going to give you the predictable cash flows. I know where I was going before. So when people think about strategy, right? Like, they're like, well, who knows if they're going to be able to pay these dividends. Well, do you know, like, if the guy in the firework tent is going to be able to pay the rent? Do you know if the guy in the taco truck that you're leasing to get an extra bump in your NOI, or the hairdresser at the salon, or like the nail guy, like, when you're in the commercial real estate space, you see all these businesses, and
It's risk assessment is what you're describing.
yeah, and it's like, well, I think I'd rather I think I would rather lease to a Fortune 500 company that has billions of dollars on their balance sheet, not future cash flows. Like, when you're leasing to like a sandwich shop, you're hoping that, like, they're going to keep making sandwiches every month, and that the customers are going to enjoy those sandwiches. What happens if somebody gets food poisoned from that restaurant and people stop going? You, as the landlord, like, you're betting that this guy is going to keep a clean kitchen, he's going to keep a good reputation, he's going to show up every day, he's going to serve his customers, and he's going to treat his customers good. And the banks and like the finance guys, like, you're just like numbers on a page to them, right? They're like, oh, this real estate operation spits out 100 grand a year, whatever it is. And when you're like in the trenches and you're collecting rents and you're working with the tenants and making sure that their business, if it goes through like a down or drought or like a down spell, like, that they're going to be able to keep chugging along and succeed. Like, you're doing a lot of underwriting on these businesses when you give them a space. Like, there's plenty of businesses when we were leasing up our buildings where we passed, right? I don't
Yeah.
know if this is going to work. Like, let's see your business plan. And, like, we're happy to kind of give businesses a chance, but if we don't think that they're going to last 2, 3 years, it's not worth it for us to have like a vacancy every year where we're going to have to repair up the building. They drilled holes in the wall or whatever, and we got to even though we got the security deposit, it's time and energy to repair those things. And
I think you're hitting on a really big topic, which is I think all tenants in commercial real estate need to be reassessed, revalued, because the risk that exists today was not there when these tenants were, quote unquote, rated. And to your point, right? You'd rather have the Fortune 500 company, but I would also make the counterpoint to that is I think the Fortune 500 companies, they get, A credit ratings by default a lot of the times, where you now see, depending on what kind of line of work they're in, those incumbents are actually at the greatest risk of disruption for a variety of reasons. They move the slowest. They got lots of layers of bureaucratic, decision making, and that is a problem when you're in the age of AI, right? And your business model can get one-shotted overnight, like full stop. That is not being talked about or fully appreciated in CRE at the moment, right? I mean, if you're making, if you're Starbucks and you're making coffee and all that's one thing, right? But if I think about the easiest example I could give here is some of these SaaS or technology companies that occupy big office buildings, right? And they traded at, premium cap rates the last handful of years on 10, 15-year leases. And now all of a sudden we're in the age of AI. You got, was it Mythos and Fable 5, all the other models. There's a high likelihood that those models are going to completely obsolete the business model, and or those models are going to find a major flaw in their product or in their systems. So that, and again, this is a whole nother topic, another episode, for sure. But I think tenants, the risk of the tenant profiles need to be reconsidered entirely, right? And this also dovetails, Kenny, back into our conversation about appraisals, right? And how the appraisal industry is just so old and antiquated and ripe for disruption. The tenant credit and the risk of the rent roll, those go part and parcel with this. And to kind of put a bow on all of it, I mean, this is the selling point of why you need to integrate Bitcoin into your real estate, because you have no idea where the next blind spot is. You have no idea, what tenant's going to get, obsoleted overnight. You have no idea where the interest rates are going. Like, you go through all these different risks in real estate, and, having Bitcoin and cold storage is your solution to that problem, right?
yeah, I just think it's so wild. Like you could get some income from a food truck and it's worth 20 times its cash flow, right? But then you get some income from strategy, and it's zero on the, as far as like the lender is concerned. It's like, it's ridiculous. It's like,
We gotta season it, Kenny. We gotta season it. Put some
it like
salt,
really,
put some
it
pepper,
hurts my
add some
brain.
garlic.
Like, it's like, why, like, how is this, how long is this going to go on for? Um, because it's like, it's almost insanity.
Approximately 24 months more, considering we just had was it STRF's first birthday?
Yeah, I think STRK is actually like 18
Or STR.
months.
Okay.
But that was something that I'm not certain on, but I think that the updated frequency is going to help it get seasoned a little faster, because it sounds like it might be number of payments, and maybe that's going to be extremely beneficial to SATA and Strive with their daily dividends, because maybe, like, it's not, like, duration, like, years, but maybe it's the payment frequency, and if it's the payment frequency, we might be waiting a less amount of time. Strategies bi-monthly, SATA's daily. Um, maybe if we're able to show that these digital yields are 24/7 essentially, or going to the 24/7 direction, right? Like that's where we're headed, where it's just going to stream. Like, it's possible today to stream the sats, right? Like you can use tools on Lightning. There's a cool tool. I don't know if you guys heard of it. We're getting into like the technicals, but Noster Wallet Connect, which has a dual purpose to be like a subscription kind of an event for Lightning payments. You can actually send a Lightning payment every second, and so like I could see SATA one day go from daily from the daily dividend company to the by the minute dividend company.
I got to jump here, guys.
All right. That's it for today's episode. If you found this conversation useful, please share it with a partner, a client, somebody making real decisions in the market. New episodes drop weekly. Until next time, stay disciplined, think long term, stack Satoshis, and from all of us here, have a happy and safe 4th of July. This is the Real Estate Standard. If you enjoyed today's conversation and you own commercial real estate, we'd encourage you to think about how these broader shifts might impact your own property over the next decade. Many owners are starting to reconsider how they structure their balance sheets, manage capital, and position their assets for the future. If you'd like to explore how some of these ideas might apply to your own situation, you're welcome to reach out. We work with property owners and investors to think through strategy, structure, and long-term positioning in a rapidly changing market. You can find our contact